Let's further analyse the markets now with Adam Dawes from Shaw Partners. Adam, I want to bring you in here on these massive swings in the share prices. They can't really be enhancing investor confidence. Is there anything you're seeing out there at the moment that's going to necessarily soothe the nerves? Because it's actually the gyrations as much would be causing the worries in the market right now.
Yeah, absolutely. And I've been speaking to a lot of clients today and yesterday just around this market and just around how we're going to actually navigate it, because the volatility is exactly what you're talking about. That volatility is actually really quite unnerving for a lot of retail investors. So we're certainly looking to keep everyone calm, because I think this is what we call a mid-cycle issue, or a mid-cycle pullback inside of a longer bull market.
Okay, yeah. In other words, what you're saying is don't imagine that the run in equities in particular is over yet, because even generally, and this is historic, that even when interest rates rise, generally markets keep on going. It's generally when there's one interest rate rise too many that's the problem for markets. It's actually not the beginning of the interest rate rises that's the issue.
You're absolutely right. The first couple of interest rate rises are going to be okay. I mean, we're 10 basis points for the RBA. They're looking to at least raise another 2 interest rates in August this year. That's going to take them 2, maybe 3 years to get back to what potentially is a normal level of interest rates, which is around about 4% for the RBA. So yeah, absolutely, this is a mid-cycle issue, and certainly it's the last ones, as you well pointed out. It's the last interest rate rises that actually then start to unnerve markets and potentially then put some real handbrakes on earnings growth going forward.
Okay, some also suggest that some of the so-called tech stocks will actually benefit when, really, if you like, the overall market falls in response to what's taking place on the NASDAQ, and with, say, for example, those Meta shares. But say, for example, you look at companies such as Seek or Real Estate, REA, which reported today with a very strong result. I mean, this is where, again, some of the bargain hunters can jump in if they've got the right timing and the right know-how.
Yeah, absolutely. I mean, you look at the tech rout that happened many years ago. The difference was that there was absolutely no earnings coming through. Now we're in a very different situation where there are actually earnings, and these are real businesses going through. Seek got hit pretty hard today, as you rightly pointed out. But REA, or Real Estate Group, that actually had a fantastic run today. They reported 33% up in EBITDA or profit. They gave shareholders a fully franked interim dividend of 75 cents, which is 27% higher than last year. And they actually came out and said that they had 145 million people on their website for a month. And that brings them up to the 7th largest online brand in Australia. So, yeah, there's some fantastic numbers there for us to keep an eye on. But REA, a very good company at the moment.
Okay, can I take you to one other issue, and that is that the theme of this week has really all been about the talk of higher interest rates. Now, generally, when you get talk of higher interest rates, yield-bearing companies, I'm thinking about the likes of Telstra's or the likes of the banks, they generally fall because everybody understands that if interest rates rise, then basically their prices have to fall for their dividends to reflect those rising interest rates. That's the same as government bonds. All bonds do the same thing. Now, the point is that, however, what might be missed here is if the dividends are rising faster than what the interest rates are rising, that could actually be the get out for many of our banks if they show faster growth as these interest rates start to rise.
Yeah, absolutely. And you can see why the banks would do well in a rising interest rate environment. And that's generally due to the fact that they obviously borrow money and then they get deposits as well. And so that net interest margin we expect can, over the next 2 to 3 years, potentially go up by about another 25 basis points. Now, that's pretty significant when you're talking about very large sums of money. And we've also done some numbers on the banking sector and how interest rates do affect them. We expect that the Big Four could probably generate another $5 billion worth of revenue in the next 2 to 3 years as interest rates start to move higher. So, look, that's certainly some positive news for the banks, as well as those higher dividend-paying companies going forward.
And it was interesting just seeing the quarterly numbers coming out of Westpac this week. We'll see the Commonwealth Bank with its half-yearly numbers coming out in the week ahead. We'll have Matt Common, the chief executive, here on the program. But the one thing about that is it was about that net interest margin being squeezed up that made a bit of a talking point about those Westpac results. But what has also been forecast is as soon as you start to see an increase in rates, that net interest margin widens, which means, in other words, so long as they can write the volume of loans, they're going to be making more money.
Yeah, absolutely. And the net interest margins for everybody at home is basically the difference for the price that they actually borrow the money at to where they actually send that money out. And that's that margin. That's that margin that sits in between that, and that's where they make a lot of their profit. So, yeah, it is good news, and expanding that interest margin has certainly been a story that the banks haven't had in a very, very long time.
Okay, so in the week ahead, I mean, the results start to flow. We start to see more of the information. We know supply chains is going to be one issue, and their difficulties are going to be, sort of, if you like, in those forecasts, and that could knock some companies around. Are there sort of any headlines you're looking for over the next week or so that investors should keep an eye out that might be, if you like, bellwethers for the rest of the market?
Wage growth. It's got to be the biggest thing that's out there at the moment. We haven't seen any wage growth going forward for many, many years now, and certainly now looking at that, wage growth is going to start to tick up, and that's what the RBA did talk about today and yesterday and the day before, where they put out their notes. They basically said that they're going to remain patient, but they are going to keep an eye on wage growth, and that's going to be a real predictor for interest rate rising here in Australia. So that's one thing I'll be looking at. The second thing I'll be looking at is how fast and how quickly the US is going to be raising interest rates as well. And then that will also be a bellwether for our market going forward. So yeah, lots to look at next week.
So I was going to say, plenty to look out for next week, plus these company results coming through. All of that's going to have some bearing on the Australian dollar, and even on Business Weekend. We're going to be talking mergers and acquisitions there, and whether the very low Australian dollar is going to bring more money into Australia and more attraction to buy some of these businesses that are growing faster in Australia, and in particular, some of the tech companies as well. Adam Dawes from Shaw & Partners, appreciate your time here on Business Now on a Friday. We thank you very much, and we'll talk to you again very, very shortly.